In this video, we're going to be looking at trend lines and channels. And some of the objectives discussed in this video include drawing trend lines and channel lines, the role of gaps and strong bars in trend line construction, and the final, looking at the significance of apexes with respect to price and time. So, what are trend lines? Well, trend lines are diagonal price barriers to price that project potential levels of support and resistance, and once trend lines have been established, the market will have a tendency to bounce from or reverse at these trend lines. So they are drawn by connecting at least 2 points and projecting the line forwards into space. And a lot of you are probably familiar with trend lines on a basic level. And the simplest way of finding these trend lines is by connecting the highs and the lows in price. Now that's good, but there are some other important methods that you need to know to be able to find the most significant trend lines in charts, as we'll discuss shortly. So they can be ascending or descending, and there's an example here of what a trend line might look like. Now the trend line is drawn by connecting those two lows from early on. We can see here and here. And then you project the line forward into space, which extends it. The trend line acts as support again later on in the chart on a few occasions. You can see here, here, and here as shown. Now channel lines build on the concept of trend lines. They make use of the fact that trend lines are parallelizable, which means other lines parallel to the original trend line will also act as a price barrier, and they are constructed by projecting a line parallel to an existing trend line from a significant point. So while you need at least 2 points to draw the initial trend line, a parallel trend line can then be drawn using just one new point. So here's an example of a trend line and channel in wheat prices. The trend line is established by connecting the lows at A and B. The price then makes a third test on the trend line at point C and reverses strongly, you can see, towards the upside with a strong bullish Marubozu, which we talk about in another episode of our video series. Now once the trend line has been established after point B, a channel can be made by projecting a parallel line from the high at point D, where we have, coming up next, there we go, at point D. And that means that we can have that upper channel line in place as soon as the low at B is made, which kind of gives you a little bit of a channel here. Now after the reversal at C, the price rallies strongly and exactly to where the channel line finds it at resistance, interestingly, where this D connects to the next point. So the price hits this point of resistance and reverses all the way down to where the original trend line finds some support, and then it continues from there on. Now, let's start talking about choosing the points to draw trend lines, because most people only know how to connect highs and lows, and that's okay. But markets often respect trend lines drawn like that. But you can go beyond that to find the most relevant trend lines in a chart. And the first step is to look at price gaps and strong bars. So see in the example in this chart, the trend line is drawn by connecting the actual lows, which will have some arrows come and connect here. The actual lows in price, that's above the red arrows. You can see that the trend line here is slightly off because the price is a little bit lower here than the trend line support. And the price doesn't really respect that trend line support as you like to see. And that is the point shown by the red circle being slightly off. Now, the reason the trend line doesn't seem to work very effectively is because we're looking at the wrong trend line. The correct trend line is drawn by connecting the lows of the strong bars that came just after both of the lows, pointed to by the blue arrows, which will come up right now. You can see that the trend line now is being respected, and by adjusting the trend line to connect these strong bars rather than the actual lows from the trough, of those bars that was in the red circle earlier now fits perfectly on the trend line. So strong bars are often more significant than the actual price highs or lows. So look at this first strong bar, for example. It seems that this one was where the major part of the move really kicked off, not at the actual low. That first strong bar shown here, if anybody can't see what we're looking at. And then by using the angle of this new trend line, we were able to go from here to here, you can see, correcting the trend line. We're drawing a new channel from a later low, and then you can see how that channel line was crucial to understanding market action later in the chart. If we had used the actual lows for the first trend line, as we did initially, the angle of the channel line would have been off too. It would look like the market wasn't respecting it, when in reality, it was just because the trend line was drawn incorrectly. So there's an example of when extremely important trend lines in the chart were revealed by using strong bars or candlesticks instead of the price lows. So let's have a look at the gaps in the next example. This is an interesting chart of Apple shares through the period of the 2008 financial crisis. The first trend line we're going to draw is constructed by connecting this significant low here with the top of this gap. So we're using the start of the gap down as one of the points to draw the trend line. And at this point, technically, that trend line is only tentative because we have 2 points used to draw on it instead of 3. It hasn't been confirmed by a third test. However, you can get retrospective confirmation by projecting trend lines back in time too. And when we do that, you can see that we've had a confirmation here with this strong bar reversing from that trend line, you can see. So now we really have 3 points that kind of confirms this trend line here. It confirms the relevance of it. So we know that the trend line has been confirmed, and we will thus draw a parallel channel line from the prior historic top. And you can see that the channel line proved its usefulness when the shares reversed from it spectacularly in the second leg of the 2008 meltdown. You can see this is that parallel trend channel line that we've drawn, and we can see that this is the area of res that seems to be holding. We can also draw another channel line from projecting a previous significant low. This too proved to be extremely useful as it accurately caught the final low in Apple shares, as we can see here around $9.50 around November 2008. So in this chart, we found the most significant trend lines which made sense of the entire bear market, where we found by using a price gap here instead of just price highs and lows. And if you only knew to use highs and lows, you would have missed all this vital information. And gaps are extremely important markers for geometric analysis. We can also use useful information, or rather get that useful information, from the intersection of two trend lines or apexes, which we could use here. Now these are the apexes of the triangles formed between two trend lines. Apexes are frequently good timing indicators for reversals. We've got an example here from daily gold prices. We have two trend lines which are both confirmed by multiple tests, and the time of this intersection, even though the price was far above the apex, coincided with a significant reversal. You see there? That's that point where they intersect with each other, and there was a significant reversal for some reason above that. And the price level of apexes can also be used as a horizontal price barrier. Here's an example where the price level of the intersection of the two trend lines was revisited by price later in the chart, where it swiftly reverses. Let's get the animation up really quickly. You can see there was another reversal. You can see here. At this point, there's a bit of res, that horizontal line, the apex where they cross. We just extend a horizontal line outwards, and for some reason, that seems to be an area of res in this case. Now, a lot of you have probably realized from this video that there's a lot more to trend lines than simply connecting tops and bottoms, and we've covered a lot already, which is more than enough for you to go and practice and become more comfortable with it. But I want to go through one final more advanced example to show the extent of the information hidden in trend lines. So don't worry if this one feels too difficult. We've covered more than enough to help you analyze charts thoroughly already. As you get more experience, you'll place more conviction in your own ability to identify the significant pivots for constructing trend lines. So let's start here with a simple trend line that connects two early price lows and continues to act as a price barrier throughout the chart. And from that trend line, we can project a parallel trend line, which correctly identifies a number of significant peaks. And we can draw another trend line which cuts through price and acts as both support and resistance during this retracement. This is a descending trend line, and we find it forms an apex with the first trend line. The price happens to cut through the trend lines almost exactly through the apex. Now, the time of the apex does not align with a reversal. In this case, the price level was actually used as significant resistance to the right of the chart. But I'm not interested in that for this example. What we're going to do now is actually use that apex as a starting point for a new trend line. So we're starting a new trend line from the point of intersection between two other trend lines. And you can see why experience is important, because it's vital the first two trend lines were drawn correctly. Or you go down further and further down the wrong path, adding more and more flawed trend lines, and you're not really going to get anything out of it. But you can see here, by connecting the apex with the price low that was formed shortly after, we have a trend line which was respected by price much later on. And that can be shown here by the blue arrow. You can see that there was a connection somehow here. Now, more than that, when we zoom out a little bit, you can see that the same trend line was used as resistance for a minor retest. Now let's get that here a little bit. So let's zoom out a bit. We can see that this was a really significant test because of how powerful the market reaction was. The market actually rose up to test this trend line here and collapsed out of it, falling 12% in just 4 days. And it clearly was an important trend line and thus an important reaction. So, to conclude, trend lines and channels offer extremely valuable information on the inner workings of price action. They can be used to anticipate reversals with remarkable precision way in advance of the event occurring. You can find trend lines on a basic level just by connecting peaks and troughs, which is fine. But if you want to step it up, you can start to incorporate strong bars and gaps into trendline construction and apex analysis. And of course, they can be even more powerful when combined with other technical indicators. It can be especially effective when price tests an important trend line while in overbought or oversold conditions. So you might want to check out our videos on indicators like the RSI or MACD oscillators to help identify overbought and oversold conditions if you haven't done so already.